Well, we got a much anticipated announcement from the Treasury this morning. The department said it will increase the size of its bond auctions in a much awaited refunding plan. It will start with an auction of $112 billion next week to refund $102.2 billion of T-notes set to mature November 15th. Here to break it all down for us is our very own Jared Blikre. Jared, this is something that people are watching as much as the Fed decision.
Rochelle, it really is, because nobody really knows about the Treasury Borrowing Advisory Committee. But I'll tell you what, I've been following them since the global financial crisis. This is a group made up of some of the representatives of the largest investment banks like JP Morgan, Goldman Sachs, that advises the Treasury. And they tell the Treasury, well, we've looked at the marketplace. Here's how much we think you should issue in debt in various maturities. And then the Treasury takes that into consideration, and then they issue their guidelines. We now know, and let's go to the Wi-Fi Interactive, what the auction sizes are going to be next week. Now, as you said, this is actually more than the previous quarter. We have $48 billion in 3-year notes, $40 billion in 10-year, and $24 billion in 30-year for a total of $112 billion. But that's actually a little bit less, $2 billion less than the TBAC, or the Treasury Borrowing Advisory Committee, had talked about with and recommended to the Treasury. I want to show you something that's happened over the last quarter, and this is a tremendous rise in yields. This is the U.S. Treasury curve. Over here, we have the short end, which is higher than the long end, and it's inverted. Now, the top line is where the yield curve is today. The bottom is where it was 3 months ago, and there is an 85 basis point increase in the 30-year. And this was a huge topic of discussion for the Treasury with its advisory committee, and they were talking about it being the effect of term premium. Basically, that's a catch-all. That's a catch-all category that is basically representing what investors would be compensated to take on the risk in a Treasury market if they purchase that security. So here's what they're saying. Term premium entered the quarter at historically low levels, even though these low levels had persisted for many years. But they talk about the fundamental factors going on in the Treasury market and why those yields may be screaming higher. QE, pension fund asset reallocation, caps on money market fund assets, decreasing fraction of U.S. Treasury supply going to overseas holders. That's China, that's Japan, bank shortening duration. The bottom line is there's a huge amount going on in the Treasury market, which is not completely understood. I want to just fast forward here to a couple more slides I have. This shows that the direction of Treasury auctions, that is going up. Increased supply means we could see higher Treasury rates. And finally, just want to leave you with this. The U.S. debt servicing costs are rising. And this is 2023. We're pushing $600 billion. It's a political football, but you can see based on this chart that the Treasury market is in the forefront, whereas it was kind of taking a back seat in investors' minds probably prior to last year.
Yeah, that mounting debt certainly one of the big reasons why investors are watching this so closely. Jared Blikre, can count on you for a lesson in bonds there. Appreciate the time.